We thought the Clarity Act failed because of disagreements over definitions. We assumed it died because the Senate couldn't agree on jurisdiction. But the real reason the most important crypto bill of 2026 collapsed isn't about regulation or consumer protection. It's about a $6.6 trillion nightmare scenario that has America's biggest banks terrified of extinction. For weeks, we've been told the banking lobby killed the bill to protect the financial system. But when you examine the real mathematics they discuss in closed-door earnings calls, you realize they aren't trying to save the economy. They're trying to save themselves. There's a massive gaping hole in the traditional banking business model. A hole that stablecoins were about to expose. Banks realized if they didn't kill this bill, they stood to lose 35% of their deposit base overnight. My name is Alex and this is Web3 Verse. I'm not a financial advisor and nothing here is financial advice. This is educational content showing exactly how the financial sausage is made and why the chefs are trying to ban competition. If that sounds good, smash that like button. January 2026, the Digital Asset Market Clarity Act was supposed to be the endgame. After the Genius Act passed last year giving us basic framework for stablecoin issuance, the Clarity Act was designed to settle the market structure question once and for all. Senate Banking Committee Chairman Tim Scott had been working on this for months with bipartisan support. Then on January 12th, just days before the scheduled markup, a new draft appeared. Buried deep in the text was a provision that looked innocent to laymen but was essentially a declaration of war to the crypto industry. The provision explicitly banned digital asset providers from paying interest or yield simply for holding stablecoins. To put that in perspective, total U.S. commercial bank deposits sit around $18.6 trillion. We're discussing roughly 30 to 35% of all money held in U.S. banks just walking out the door. Imagine if Walmart suddenly lost 35% of its customers to a competitor selling the exact same products for cheaper prices. Walmart would collapse. Banks know this. But their argument, the one they used to lobby the Senate, wasn't just we'll lose money. They played the economic collapse card. They argued this deposit flight would destroy the lending market. According to Federal Reserve data, there's a multiplier effect to bank deposits. For every 100 billion in deposits that leaves the banking system, banks are forced to contract their lending by anywhere from 60 billion to 126 billion. So if 6 trillion leaves, we aren't just discussing empty bank vaults. We're discussing a contraction in credit that could reach into the trillions. This is the narrative they sold to Washington. They said if you let Coinbase and Circle pay interest, we won't be able to write mortgage loans. We won't be able to fund small businesses. We won't be able to support farmers. It's a classic protectionist racket. Protect our monopoly or we crash the economy. The banks had their narrative. Stablecoins will drain 6.6 trillion and crash the economy. They had their lobbyists flooding Capitol Hill with letters. The result was that January 12th draft of the Clarity Act. The provision they inserted was clever. It didn't try to ban stablecoins. That would have been too obvious. Instead, it tried to ban passive yield. It said a crypto service provider cannot pay you interest solely for holding a stablecoin. They tried to frame this as a safety measure. They argued that if a crypto platform pays yield, it's acting like a bank and should be regulated like a bank. But Coinbase CEO Brian Armstrong saw right through it. On Wednesday, January 14th, just one day before the markup was supposed to happen, Armstrong publicly withdrew Coinbase support for the bill. He called the provision exactly what it was: a kill switch for stablecoin rewards. He said it felt deeply unfair that one industry would come in and do regulatory capture to ban their competition. Armstrong realized that if this bill passed, it would cement the bank's advantage forever. It would make it illegal for crypto to compete on price. Coinbase withdrawal was the final nail in the coffin. Without support of the biggest crypto company in America, Republicans on the Senate Banking Committee got cold feet. On January 15th, Chairman Tim Scott postponed the markup. The bill collapsed. For a moment, it looked like a victory for crypto. We stopped a bad bill. But the irony, and I mean the deep, painful irony, is what's happening on the other side of the world. While the United States is tearing itself apart trying to ban digital currency yields to protect legacy banks, China is doing the exact opposite. As of January 1, 2026, the People's Bank of China officially shifted the digital yuan, the ECNY, from being just digital cash to being digital deposit currency. And guess what? It pays interest. Yes, you heard that right. The authoritarian Chinese government is paying its citizens 0.05% interest to hold their central bank digital currency. 0.05% might not sound like much, but it's the principle that matters. China has recognized that for a digital currency to compete, it needs to offer utility. It needs to offer yield. They're incentivizing adoption by making the digital yuan a superior product to physical cash. Meanwhile, the free market United States is using the power of federal government to ensure that digital dollars remain inferior to bank deposits. Coinbase chief policy officer warned we're handing a massive competitive advantage to foreign CBDCs and offshore stablecoins. Think about the global implications. If you're a merchant in Brazil or Nigeria or Indonesia and you have a choice between holding a US dollar stablecoin legally banned from paying interest or a digital yuan or euro stablecoin that pays yield automatically, which one are you choosing? Capital flows to where it's treated best. Right now, US banking lobbyists are ensuring capital is treated worse in America than almost anywhere else. The Clarity Act is stalled. Banks have shown their hand and we're in dangerous limbo. There are 3 ways this plays out. Scenario 1. Legislative stalemate continues. Innovation moves entirely offshore. We'll see rise of wrapper products. You won't earn yield on USDC directly. Instead, you'll wrap it in a DeFi liquidity token that happens to pay 4% APY. Innovation always finds a workaround. Scenario 2. Watered-down compromise. New draft allows activity-based rewards. You can't earn yield for sitting on money, but you can earn yield for staking or transacting with it. Banks are okay with this because it requires spending money to make money. Scenario 3. Technology simply wins. Banks are fighting a war against efficiency. They're trying to maintain a 3.5% spread in a world where technology has reduced that spread's cost to near zero. It's like the taxi industry fighting Uber. They can ban it, regulate it, make it difficult, but they cannot uninvent the efficiency. If the US bans stablecoin yield, the market will simply move to decentralized protocols that no CEO can switch off. The $6.6 trillion exodus Brian Moynihan is afraid of is going to happen. Maybe not today, maybe not tomorrow, but you cannot keep trillions of dollars wrapped in 0% accounts forever when technology exists to set it free. Banks have won this round. They killed the bill. But in doing so, they've revealed exactly how terrified they are. They see the future, and it doesn't include them earning 3.5% on your money for doing absolutely nothing. Is Brian Armstrong right to kill the bill and hold out for better terms? Or should crypto have taken the deal for regulatory clarity? Let me know in the comments. Thank you for watching Web3verse, and I'll see you in the next one.